America's mortgage debt is not just a pile of loans. As of the first quarter of 2026, mortgage balances stood at about $13.19 trillion, which is the balance sheet scale of the option we are about to uncover. Inside that pile is a hidden option. It is not traded on an exchange, but it lives inside contracts and changes borrowers, investors, and bond markets when rates move. The strange part is, who owns it? The homeowner controls the timing option, while the investor receiving the mortgage cash flows is short that choice. When rates fall, the borrower can refinance. The old high-coupon cash flow disappears exactly when it has become most valuable to the investor. When rates rise, the borrower usually stays. The expected cash flow life stretches, effective duration extends, and that asymmetric timing is mortgage negative convexity. Start with a normal fixed-rate bond. Yield moves left to right, price moves up and down, and when yields fall, the bond price rises. But the price-yield curve is not a straight line. The bend is convexity, the second derivative of price with respect to yield, scaled by the bond price. For a plain bond, that bend is friendly. Falling yields help more than rising yields hurt for the same small move, which is why positive convexity is valuable. Now replace the plain bond with a pool of mortgages. The upside begins to flatten because borrowers can take the high-rate loans away by refinancing. That is why mortgage convexity feels backward. The investor gains less when rates fall, but can be left with more effective duration when rates rise. For the borrower, the option is not abstract. It shows up as a monthly payment because refinancing is an option exercise expressed as household cash flow. The standard fixed-rate payment is principal times a rate term divided by a discount term. Same loan, same maturity, different rate, very different payment. CFPB calculated that on a $400,000 loan, principal and interest rose from $1,612 at 2.65% to $2,877 at 7.79%, a payment gap of $1,265 per month. Run that logic in reverse. If market rates fall far enough below your old rate, refinancing becomes an in-the-money option because the new payment can be materially lower. In simple form, the incentive is the old rate minus the new rate minus the rate equivalent refinancing hurdle. The borrower chooses when that gap is large enough to exercise after frictions, paperwork, and time. If refinancing were perfectly rational and frictionless, every borrower would prepay as soon as the option was positive. Real households are not option pricing robots. Real mortgage pools do not behave like a switch. They behave like an S-curve, where probability rises gradually as the refinance incentive improves. At negative moneyness, borrowers still prepay for life reasons: moving, selling, divorce, job changes, or cash-out choices. This creates a floor under prepayments. As moneyness turns positive, refinancing becomes attractive and prepayments rise. But the curve does not reach 100% because frictions and borrower differences remain. Foster, Luca, and Vickery report that aggregate 30-year agency MBSCPR ranged from about 55% in the 2003 refinance wave to about 10% in 2008. That range is why a smooth curve beats a clean switch. In market language, prepayment speed is often annualized as CPR. The formula is 1 minus 1 minus SMM raised to the 12th power, turning monthly prepayment behavior into an annualized speed. Now, the price can be written in one line. Mortgage-backed security price equals scheduled mortgage value minus the borrower's prepayment option, the value of cash flows the investor may lose early. When rates fall, the scheduled mortgage becomes more valuable. But the borrower's option also becomes more valuable because the incentive to replace the old loan is stronger. So the investor does not receive the full benefit of lower rates. The mortgage pays back early, principal returns sooner, and the high coupon is gone. When rates rise, the option moves out of the money. Prepayments slow, expected cash flows extend, and the same security behaves like a longer bond. This is negative convexity. Less upside in rallies, more extension in sell-offs, and an expected life that changes when the market moves. The expected cash flow timeline is not fixed in time. In January 2021, Freddie Mac's survey hit 2.65%, the lowest 30-year fixed mortgage rate in its history, dating back to 1971. That low-rate environment created a refinance wave. Freddie Mac estimated about $2.8 trillion of first lien refinance originations in 2021 as borrowers exercised the option at scale. For 30-year fixed-rate borrowers who refinanced to lower their rate in 2021, the average annual principal and interest savings was about $2,695. The option had household value. Then, the option flipped. By October 2023, the 30-year fixed-rate mortgage averaged 7.79%, and by May 2026, it was still around 6.51%, far above the pandemic trough. At higher rates, many existing loans are out of the money to refinance. The option does not disappear. It becomes dormant, waiting for rates, credit, and borrower incentives to change. The Federal Reserve saw this in its own MBS runoff. After holdings rose from $1.4 trillion in early 2020 to $2.7 trillion in mid-2022, principal payments later ran below the $35 billion monthly cap because fewer mortgages prepaid. Once mortgages are pooled into MBS, this is no longer just a household decision. A small borrower-level timing choice becomes duration risk for institutions. When rates rise and prepayments slow, MBS duration extends. A hedged investor may need to sell duration through treasuries, futures, or swaps to restore the original risk profile. That selling can push yields higher, which can extend mortgage duration again. The hedge becomes a feedback loop, not because of conspiracy, but because balance sheet risk has to be managed. When rates fall, the sign can reverse. Expected prepayments rise, duration shrinks, and hedgers may need to add duration instead, changing the market pressure. Samuel Hansen found that past quarterly shifts in MBS duration were sometimes equivalent to a $1 trillion increase in 10-year Treasury note supply, measured in 2012 dollars. That is the scale of convexity leaving the mortgage book. SIFMA's 2026 Data Show Agency, MBS trading, averaged roughly $396 billion per day through April. This is market plumbing at institutional scale, where tiny changes in prepayment expectations can matter. The honest version is not that every borrower refinances perfectly. They do not. And the model is only useful if it keeps that imperfection visible. Credit, paperwork, moving plans, home equity, taxes, servicing frictions, and simple inattention all matter. They turn a textbook option into a messy human decision. That is why the S-curve never becomes a vertical wall, and why old pools can burn out after the fastest refinancers leave. The remaining borrowers are often slower to react. Also, the $13 trillion headline is mortgage balance scale, not a claim that every dollar is identical, securitized, or equally hedge sensitive. The framework is this. A mortgage is a loan to the homeowner, a borrower option the investor is short, and a moving duration problem for the market. So when rates move, do not only ask what the monthly payment becomes. Ask who owns the option, who is short it, and who has to hedge when the option changes shape. This is not financial advice. It is the math behind a market where a normal mortgage becomes a hidden option, and where that option changes the shape of rates themselves.